The following podcast was recorded on Wednesday, June 16th, 2021, featuring Jim Bianco and Greg Blaha of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome to the latest edition of Talking Data. Our Talking Data series seeks to offer timely insights into macro market themes along with macro data and its impact on the economy and markets. I'm your host, Kristen Radosh of Arbor Research and Trading. I'm joined today by our presenters, Jim Bianco and Greg Blaha of Bianco Research. Today, Jim and Greg will take a look at how decentralized protocols manage to borrow and lend in a permissionless manner. We've done a series on DeFi, and this is our next. We're going to dive into borrowing and lending. Greg, if you could start us off today, how big are these protocols?
So yeah, you're right. We've started with kind of a couple concepts. Last week, I believe it was, we talked about stable coins. We've also talked about automated market makers. So this would be kind of the next big topic that we wanted to tackle here. And how exactly does someone go about either borrowing or lending money in a decentralized manner and a permissionless manner for that fact? So we'll start by zooming out here and just looking at how big these protocols are. If we go to the first chart, we can see that probably in the early middle part of May, these protocols got about $50 billion worth of money locked onto their protocols, so either being borrowed or lent. And after the crash in mid-May, that has kind of come down to about $35 billion or so. So these are, a far cry from what we would consider the traditional banking system, but keep in mind that they have grown from essentially zero a year ago during the DeFi summer of 2020. So if we want to go to the next chart, we'll get an idea for who some of these biggest players are in this space. Aave right now is the biggest lender and borrower, and Maker and Compound, those are kind of considered the big three. If you're either borrowing or lending money in the DeFi space, this is where it's happening for the most part. Maker was kind of the original kid on the block, and they found out a way to allow people to post collateral into what they called a vault, and then they would mint DAI, which is their version of a stablecoin dollar. So people could essentially put ETH into a vault and take out DAI and then do whatever they want with it from there. And then Aave and Compound came around a bit later and kind of iterated on those ideas. Compound decided that they were going to focus on both borrowing and lending, and they also kind of threw their governance token out there as an incentive to bring business into their protocol, that they said, if you're either borrowing or lending money through us, then we'll give you the comp token, which allows you to have a voting right, and it's just a governance token. So it's similar to a share of stock, but there are differences there. Aave, which is now the biggest one, has iterated even further on that. They came up with concepts such as flash loans, which are more or less the equivalent of like a repo transaction. They've also figured out a way to do stable APRs for borrowing and lending, whereas Compound and Maker are variable. So just focusing on those three, I mean, they've got the large majority of the trades. It's about $29 billion, I think, in locked value between the three of them, out of the roughly 35 right now. So they're a large part of this market.
So a couple of comments. The amount total value locked, the TLV, which was about 50 billion, is about 35. Keep in mind that that's measured in dollars. So a lot of that decline is because the price of ETH has fallen. But if you were to kind of back that out and say how many coins are in there, yeah, it's gone down, but not nearly as much as it's gone down by that. And as Greg pointed out, yeah, you could look at this, it's $30 billion, why do I care? Because it's up from zero a year ago, and it's really taking everything by storm. As far as what these protocols are, and that's the proper term for it, they're banks is what they are, but they're fully reserved banks, not fractional reserve banks that we're used to. There was they're called the Chicago Plan in the 1930s after the Great Depression, that they talked about whether or not we would have banks be on a fully reserved basis. And what that means is that a bank would take in $1 of deposits. Today, that's what they do. And then in a fractional reserve system, they would lend out about $11 worth of loans. and that is inherently an unstable system to have that kind of leverage and that kind of maturity transformation, as they call it. So you have the Federal Reserve and the FDIC and the OCC, and you have tremendous amount of regulation around an inherently unstable system. In a fully reserved bank, they bring in $1 of assets, they lend out $1 of loans, and they lend it out at a higher rate than the interest rate offered to the depositors, and they pocket that spread. In that environment, it's a much anti-fragile system. It's much more prone to surviving problems, but it isn't as profitable, at least in the traditional centralized world. That's what they're doing here with these protocols, that they're bringing in $1 worth of cryptocurrencies, probably Ethereum, and they're lending out against it. But in their case, they're not even going one for one. They're more, Greg, you can, what is the numbers are more like 150% collateralization. So you have to put in $1 to get back, what, 75 cents worth of loans? Is that about what the collateralization rate is on a lot of these?
Yeah, they differ from protocol to protocol and depending on the asset, but that's a pretty average collateralization ratio.
Right. The point is that they're very much over collateralized as well too. And then the other thing to keep in mind is, what do people do with these loans? Well, they buy other coins with these loans as well too. And the cynic could say, it's all playing with the same magic beans in the same little circle. This is about creating a new financial system and battle testing that financial system. And we'll talk more about that when we get to over collateralization at the end.
And Greg, can you walk us through the lending process itself?
So yeah, Jim brings up a good point in that there are similarities to the traditional banking system in that these protocols by and large will lend money out at a high rate and they pay a lower rate to the people that are giving them money. So they are kind of playing with that spread between borrowing and lending and capitalizing off that a bit. And they also, obviously rates are kind of determined by supply and demand in the same way that the banking system is. And now the difference, I guess, would be that the supply and demand in DeFi is just based on algorithms. So the rates will change a lot quicker in the world of DeFi than they would in a traditional banking system where, you know, everyone's going from a 0.75% savings rate down to a 0.5% savings rate, you know, from 1 month to the next. I mean, these rates change pretty quickly in DeFi. But that's about where the similarities kind of end, I think. And to get strictly into DeFi lending here, the way this works, and I'll just use Aave as an example since they're the biggest protocol, is if I have $100 and I want to lend it out and start getting some interest on that, I go to Aave and I'll deposit the $100 on their website, and in return I'll get it's kind of,
you got to deposit a crypto, not fiat, just to make
sure. So you don't, that's a good point. So $100 worth of ETH is what you would deposit, or something, another asset, but not fiat. And in return, I would get a token. And in the case of Aave, it's an A token. In the case of Comp, you get a C token. So if I was going to deposit DAI, I would deposit the $100 of DAI, and in return, I would get a DAI. Or if it was on Comp, then I would get a C DAI token. And basically, that's just an IOU that says you've deposited this money. At any time, if you want to close out this, you know, position, then you can get back your original DAI plus the interest that you've accrued. But the token will accrue interest as long as it sits in your wallet. So what's interesting about this is that it allows for a, I guess, sort of rehypothecation that you would call it in traditional finance, that you get this token in return, and if I have a DAI or C DAI, I can then take that token and spend it or use it other places, and in effect kind of multiply the money that I have working for myself. So if I wanted to take C DAI and go stake it on some other site and start getting, you know, further interest off of that, or put it into a pool to start accruing trading fees, you know, there are ways that you can do that. So it's, like I said, it's a form of rehypothecation that is a little bit different with when you get an A token or a C token. You can use that as opposed to just depositing your money in a traditional bank and you just get interest on it every month, but there's not much you can really do with it.
One thing to keep in mind about this type of lending, as Greg says, it's very volatile. The interest rates will vary from day to day. in a decentralized permissionless world, you don't fill out any paperwork. They don't know your name. You just show up with a coin or a token, and you deposit it with them, and then they will mint, the A version or the C version and give it to you on the other side, and it's all fully collateralized. But that lends to this whole idea of yield farming, because if you did it and you're done, the interest rates vacillate all over the place. And like what a lot of people will do is they'll actively manage this process of saying, okay, I'm in this, I've lent out in this coin and I've got the highest interest rate, but now it's not the highest interest rate. So I'll close that position and I'll exchange it like on one of the automatic market makers like Uniswap for a different coin and lend that one out because it's got a higher interest rate, and that's referred to as yield farming. There are automatic ways to do yield farming. Yearn Finance is one where you could put your money in their vault and they will do it for you, or you can actively manage the process yourself as well too. So at least on the lending side, that's what you see a lot of going on with the way that these protocols have been working.
And Greg, how about the borrowing side?
So the borrowing, if we could go to this slide that shows Aave again as an example on how you would lend or borrow there. It's a bit more complicated because there is no intermediary and there's no person at a bank saying, okay, you can take out a loan, you can't, you have, enough assets in your bank to take out this much of a loan. So because of that, you need to use over-collateralization. And all these protocols will have different collateral ratios that they will require. And as the page here shows, if I was interested in borrowing DAI, which is again a stablecoin dollar, I could post Ethereum or ETH as my collateral, and the maximum loan to value is 75% in this case. So if I put $100 of ETH into their protocol, I could take out at most $75 worth of DAI. Now, in practice, no one does that because once you go above your liquidation threshold, which in this case is 80% at the bottom of the screen, then you will be liquidated. And this is all carried out on algorithms and on smart contracts. So in reality, people will post a much higher collateralization, 200% sometimes, just to make sure that you're not going to go over your threshold and get your loan liquidated. So along with considering the liquidation threshold, you also pay, in this case, a 3.76% variable yield. So you can keep that loan as long as you want, as long as you pay the 3.76% yield every year and you're not going above your liquidation threshold, then you're good to go. So what happens though, a lot of times, like we just saw last May, when crypto crashes, and if you're depositing ETH and ETH goes down 50% in a day, a lot of people are going to end up being liquidated, even if you have a 200% liquidation threshold to start out. So what happens is if ETH is worth now only 80% of your collateral, then you're going to get liquidated. And the way that works is usually through a lot of algos. Go through these protocols and you can compete to be able to liquidate someone's loan. So what that means is you will pay off their debt, and in return you will get their collateral, the borrower's collateral. Now the reason liquidators do this is because there's a 5% haircut involved. If someone's loan is liquidated, they also pay a 5% haircut on what they've put in their collateral, and that goes straight to the liquidator. So again, this is dominated by algos, and they all compete and are highly efficient in basically just closing out these loans the minute that you are no longer at the correct collateralization level.
So Greg, they just on that last point, before I give a quick comment, when you hit that collateralization level, the price of your cryptos fall to the collateralization level, aren't you given a couple of hours or something, like literally a couple of hours to either post more collateral or to be liquidated, or are you just immediately liquidated from your position?
Well, that differs from protocol to protocol. I think in the case of Maker, which they will liquidate your entire position, whereas Aave, I think, only liquidates maybe half your position at a moment. But I think in the case of Maker, you have about an hour because of the way their mechanics work to post more collateral before your position is closed out. But again, because crypto trades 24/7, I mean, a lot of times that you'll be asleep at night and the market might crash, and then, you know, there's no way for you to know whether or not, you know, you're collateralized at any moment. So it's definitely something that needs to be managed to a very high degree, and borrowing is not for the faint of heart, I'll say.
So we've talked about the size, we've talked about the lending and the borrowing. We'll talk about over-collateralization in a second. Really, what's going on here is a lot of, we're creating an the crypto universe, the DeFi universe is creating an algorithmic bank. That this bank runs by computer program in a permissionless, decentralized way, at least for fully collateralized loans. And you could argue that there's a lot of risk in there. Yeah, and that's why it's largely still in the crypto world, is that they're trying to iron out all the bugs before it eventually shows up in the real world. Eventually is a forward-looking statement there as well too. But keep in mind that in mid-May, when the price did crash 50%, there was a lot of people, hundreds of thousands of these loans were all liquidated. And these protocols didn't lose money, didn't crash, didn't experience any slowness. They just worked. And the people that borrowed too much and were on too much leverage were just blown out of their positions. And you could go to their website, like the make or burn section of the website, and you could actually see all of the loans that were up for liquidation. Anyone could bid on those loans. Oh, here's a loan with this and this, and I could go in and want to buy that collateral at the liquidation level. So it's not like when the banks liquidate, you know, when they call Warren Buffett and they call Goldman Sachs and they do a secret deal to help with the bailout. It's completely in the open, and everybody and anybody can participate in the process of either borrowing, getting liquidated, or buying busted collateral if there is a massive liquidation. And because it came through mid-May without any problems at the protocol level, yeah, a lot of over-levered people got killed. That you could argue in a libertarian sense, that's their problem. But the system itself held together, suggesting that it is a little bit more anti-fragile than you might think it is if you're just being exposed to this right now.
Greg, our final thought today, our final section is on over-collateralization. If you can just give us any more detail on that.
Right. So Jim already touched on the one aspect of over-collateralization is that the system just worked through a 50% drawdown in mid-May on the crypto world. And at the same time, a lot of the more centralized crypto competitors like Coinbase or Binance, they actually had a lot of problems. Their websites were crashing. People were trying to trade things and get rid of their positions. And at the time when they needed, you know, to be able to trade most, they really struggled. That was not the case with Aave, Compound, any of these. I mean, all these protocols came through with shining colors, and it's because they are over collateralized. You know the rules going in. If you hit your liquidation level, it's gonna, you know, close out your position right away. And it's, you know, a painful lesson to learn for anyone that is liquidated like that, but it helps the system, you know, come through during the tough times. And so that's, I guess, the positive side of over collateralization. But it is a double-edged sword. The negative side is that I think a lot of people are correct in pointing out, because of all these loans are over collateralized, the problem you have there is that their only real use, and there are some cases where this is not true, but their main use is for leverage and speculation. I mean, if I'm going to have collateral and take out, you know, a larger loan, it's going to be because I want to leverage myself and put it into more cryptos, or, you know, find another use for it. You're not going to find a situation where someone's going to be able to take out a mortgage on one of these protocols. You can't over collateralize a mortgage. Same thing for like a business loan. I mean, it's the things that where loans would actually make sense for the average person, you're not going to find here. It's largely tied to leverage and speculation. So that is one of the big knocks on these. And there's a lot of protocols that are working to try to find ways to overcome this hurdle. But in my mind, that's one of the biggest problems right now that you do see. So very recently, Mark Cuban posted something on his blog saying, banks, look out, this DeFi movement is coming for you. And I think that's true to a large degree. I mean, there's a lot of business that these DeFi protocols could steal from the traditional banking system. Now, that being said, I think that there's a lot that, at least as of now, they're not going to be able to touch. And that's, as I said, mortgage loans, business loans, those types of things where you still need someone in the middle to say, okay, you're a credit-worthy borrower, we'll give you money. You just can't do that, at least not yet to any large degree in the DeFi world. So yeah, maybe banks will have some of their profits eaten if this DeFi movement continues to grow. But as of now, that's kind of one spot, one moat that the traditional banking system has, that, until DeFi figure out a way to do under collateralized loans, that's going to be somewhere where the DeFi movement is not going to touch traditional finance.
I agree with Greg. Just on, if I could draw a parallel to it, let's go back 20 years when e-commerce started coming on board, and everybody said, oh, e-commerce is going to be the next big thing. And the traditional brick and mortar retailers said, yes, but not everybody wants to wait 3 days for their delivery. You're right. E-commerce was never able to solve the instant delivery thing. Yeah, I know Amazon's got a 2-hour thing for some stuff, but that really doesn't solve it. But it doesn't have to. It took away big parts of traditional retailing to e-commerce. This fully reserved, over-collateralized lending, which could go into deposit taking in the real world, which can go into repo lending, any kind of fully collateralized lending as well too, can take away big parts of what the traditional banking system is doing and move it here. But as Greg said, not everything. Under collateralized loans, a mortgage, you don't have $300,000 in the bank to take out a $300,000 loan to buy a house. If you had $300,000 in the bank, you wouldn't need the mortgage in the first place by some logic as well too. That is a little different because in an under collateralized loan, as Greg said, somebody's got to give you permission. Yeah, you're worth the risk. So there is still a place for some centralized finance, but big parts of what they do can be, offshored into some of this, or online into some of this stuff in decentralized world, just like stable coins to take over the payment rails for the banking system. Another big part of the banking system as well too. So I agree with Cuban, look out banks. This is coming in a big way and it's going to severely disrupt your business, but it's not going to eliminate your business. There's still going to be some things that the centralized banking world can still do better, but there's going to be big parts of it that it's going to not be able to compete with the decentralized world if the decentralized world fulfills its promise.
Well, thank you both for your thoughts today, and thank you everyone for joining us. As a reminder, Arbor Research and Trading is an institutional research and brokerage firms. Our two most prominent research offerings are Bianco Research and Arbor Data Science. For further information, please contact Gus Handler at gus.handler@arborresearch.com. Have a great day.